Welcome to the weekly mortgage rate market update for the week of October 16th, 2017. Hello, I'm John Thomas with Prime Residential Mortgage, here to give you an update. Well, last week was great to mortgage rates. They were able to actually move lower after a trend of moving higher. If you take a look at the bond chart on the screen, you can see that mortgage bonds were able to rally off that floor of support that they settled on last week. They moved higher most of the week, all the way up and closed just below the 25-day moving average, and U.S. Treasuries were able to break below the 200-day moving average. So with that giant green candle on Friday, just below the 25-day moving average, short-term trend is for the bonds to keep going higher, which would move interest rates lower. We're going to recommend you float your mortgage rate to start the week to see if mortgage bonds can continue to rally and break above the 25-day moving average, which means it gives them a lot of room to run. So we could see mortgage rates move lower in the near term if they're able to break above that 25-day moving average. So start off floating. Now, if we dig into the economic news, Consumer Price Index, or the CPI, for September 2017 jumped 0.5% from August, and that was less than actual expectations. The Core CPI, which strips out food and energy, was only up 0.1%, and it's only up 1.7% year over year. That's well below the 2% target of the Feds, and the inflation was expected to jump, and it has not. So that was very bond-friendly news. That's one of the things that helped the rally. We saw wholesale inflation, which is measured by the Producer Price Index, or the PPI for September, was up 0.4%, and that's pretty much on the wholesale level because of the price of gasoline jumping after the hurricanes. So wholesale inflation does not always translate directly into consumer inflation, as we saw with the CPI numbers. So, if we take out that spike in gasoline prices, we wouldn't have much inflation on the wholesale level, and it did not translate to the consumer level. That's what helped mortgage bonds rally. And then the third big report last week was retail sales for September 2017. We're up 1.6% from August, and are up 4.4% from September 2016. So retail sales is a measure of consumer spending. So with consumer spending jumping up, that is good news for the economy. So we'll have to see if that trend continues. Then we saw weekly initial jobless claims come out on Thursday, and claims dropped 15,000 claims down to 243,000 claims for the week. That is about where we were pre-hurricane levels. So it looks like the labor markets were in Florida and Texas are returning back to where it was pre-hurricanes. That's great news on the work numbers and how which will translate into housing. So we'll have to see if the housing market sales recover in Florida and Texas as things get back together. In housing news, we have a new loan program to help home buyers and homeowners. Prime residential mortgage FHA loans now go down to a 500 FICO score. So we will lend borrowers with scores down to 500 on an FHA loan product, as long as the borrower receives what's called an approved eligible through the automated underwriting system. Their maximum debt to income ratio they can borrow against is 45%, and as long as the credit profile meets FHA underwriting guidelines, we will do the loan. So that's going to open up a lot of opportunities for home buyers and homeowners looking to refinance. So if you or anyone you know has been turned down for a mortgage because of your credit score, please give us a call at 302-703-0727, or you can go online, www.delawaremortgageloans.net, and get the process started online, and we'll see if we can get you qualified for an FHA loan. And then in the local news, next first-time homebuyer seminar is Saturday, October 21st from 10 a.m. to noon in Newark, Delaware at the Christiana Hilton Hotel. You can register for that event by giving us a call at 302-703-0727, or online, www.delawarehomebuyerSeminar.com. Hey, look forward to seeing you guys next week.